is a friend. His Kalrock Capital invests in Germany, and right now he's based in London. And given the interest in real estate in Pakistan, especially the desire of the government of Pakistan in developing real estate as an asset class for financing 5 million homes, for affordable homes, I thought it would be great to get Georg's insight into how global capital works for real estate. How do people value real estate? What do global investors look when they're looking at real estate projects? And how can Pakistan tap international markets if they want to open up their real estate projects to international investors? So those are some of the questions which we wanted to discuss. Like with other webinars, the recording of this webinar will be available on KSB's website, ksb.com. And it will also be available on our online course, which is KSB Certificate in Investment, which is on ksb.teachable.com. More than 1,000 people have enrolled on KSB's varsity for the online certification, which makes it perhaps the biggest business school in Pakistan. So I'm very delighted about that. And this program, the recording of this will be available on that as well for students to learn about real estate investing. So with that, Georg, welcome to our webinar.
Thank you very much, Ali. I'm delighted to meet with all of you, and thank you very much for inviting me to this webinar.
It's a pleasure, Georg. Georg, starting off, of course, you have immense experience in financing and investing in real estate assets across Europe. Can you give us a sense of how big is this market and what are the types of real estate vehicles or companies which are available for investors to invest in?
Yeah, real estate is an amazing, thankful asset class, as we all use it day in, day out. It's the biggest asset class as such, if you would categorize it versus other asset classes. It's a very traditional asset class, and if you just think about Europe, the two biggest markets is Germany, UK, France, Italy. The Scandi, if you just think about the absolute amount, I mean, it's in the trillions. You see different numbers in terms of the global real estate market. You then differentiate between professionally managed real estate and owner occupied, and you see numbers up to 200 trillion as being the estimate for the value of global real estate. That was a number from HSBC in 2016. So it's in the trillions, is vast, significant, and it has a lot of different ways how to invest into it. I think before we think about the structures you could invest or you could capitalize real estate through, is what drives real estate, and that is very much the cash flow. In a simplified way, the rent ultimately you would receive through that asset and from that asset in the future. The other is, of course, how that cash flow is valued through, and you normally express that through a multiplier or reverse it in a yield, and that expands and compresses over time, to do with cyclicalities, to do with financing costs, which is a big driver. What is the interest rate environment underlying specifically for the geography you are in, and this second thing is then to the growth driver. So you have the cash flow and the growth and of that future cash flow or potential, and that together gives the total return of a real estate. So real estate is basically different phases of future then cash flows that will be reflecting then in a value that often is expressed as the asset value, often also being appraised through third parties. And if you deduct the debt, you end up with a net asset value, which is a very common like a number or value that you would see in real estate. So that differentiates from how you value companies to an extent, but ultimately the simplest way of thinking is real estate is future cash flow, which you have to assess and therefore put a valuation on that future cash flow. Of course, in the make of real estate, you have all different ways of value chains, with people buying land, creating planning and zoning it, planning on it, then developing it, constructing the buildings, letting the buildings, and then ultimately the buildings will be used as that, and then you have an investor market in the completed and yielding real estate as such. You then, of course, differentiate between the different assets classes within real estate. You find from the residential, which possibly the most commonly known, as we all use our apartments and homes, and some of them let, some of them bought. And that goes then into service. It goes into office, like service residential. It goes into offices. It goes into logistics, light industrial, an absolutely strong and booming asset class, and we can touch on that a bit later, into specialty like data centers or self-storage and so on and so forth. The question is always also within the real estate industry, how far do you go in the operational involvement in the real estate, whether you reduce it solely to the brick and mortar and ultimately that, or are you then also the asset manager of it and you find all various models in it. I think for me interesting is because it's such a vast asset class, it's been kept quite traditional over centuries basically, that you find innovation and people start to innovate how to finance, how to own, how to capitalize on real estate and on the use of that real estate. So I think it's a very interesting field.
Thank you. It's certainly very interesting. And as you explained, that it's a diverse area with trillions of dollars of capital and with various kinds of asset classes, which you described. Georg, you mentioned that there are two indicators. One is the net asset value and the second is the yield. Which is more important? And can you give us an example? You know, you were the director of capital markets of Camden Market and you bought that company to IPO. Can you tell us the case study of Camden and explain to us that, you know, how did you raise that capital? How did you go and do the debt raising? And when you were doing the IPO, what were the kind of questions which investors were looking at? And, you know, I'm asking that in the context of, you know, Pakistan, that if an investor has a project and if he approaches investor, I just want to get some insight into what are the key variables the investor will be looking at in that project.
Absolutely. Camden and at the time Market Tech was a very interesting project because it's a placemaking strategy. So the strategy here was not to focus on one type of real estate. It was rather to buy real estate in a certain area that is in a way interlinked because it's next to each other. So if you create value in one building or renovate or enhance that value, it also spills over into the building next or into the area which you become a significant owner of that area. So that's called placemaking strategy. In England is often also referred to as an estate. So you build around one area a lot of property. The very interesting and specific, possibly it's one of the few areas in the world where that have that much traffic. I mean, the traffic of people going through that estate and specifically through the Camden markets, which were included, is 35 million people a year. So it's highly dense and highly trafficked, which means, for example, for a retail environment, which are the Camden markets, very, very interesting because you have a strong footfall, and that is very important for retail and for those kind of market environments. There was also included offices, and we had offices where we started to develop co-working, like flexible office spaces, which also linked then very much into the retail and F&B, like food and beverage business, which was already established there, and therefore the people who went there for leisure could also go there to work. And that interlinkage and the last element was then on the residential side, we also integrated new residential parts, which again live, work, play in one area, which you can influence the different dynamics in a location like London with that footfall was extremely attractive and dynamic. And what does it allow you? It allows you to benefit from all those different influences, so you can really build the location and therefore also, of course, drive value. And one of the value drivers is, of course, that you can increase rent, but at the same time, it's not just the rental increase, it's also the growth potential in the future that increases value. And the other thing is, as the rent is more and more sustainable, meaning the risk that there's, like, let's say, a shop that is not being able to let because it's such a high demand, it's not necessarily just that you increase the rent, but if you would leave the rent the same, but the demand is there, an investor would also give you a lower yield or a higher multiplier on that rent, i.e. the value goes up. So I think it's that dynamic that drives it. If you think of what investors looked when we IPO'd and what investors care for these companies, I mean, Camden was because it was a placemaking strategy with different buckets, you had to explain the different parameters, because retail has a different dynamic than residential or than office, and specifically than co-working. But the key parameters, of course, for investors is the NAV, the net asset value, which is, if you take the third-party valuation that is done by appraisers, in big ones are John Lang LaSalle or CBRE or BNP, they do an appraisal on the current rent, on the ERV, which is the expected rental value, apply comparables from other transactions they have done or from other valuations, and then do a third-party appraisal. If you deduct the debt that is within the company, or you put on the project or on the building, then you arrive to, oversimplified, you arrive at the net asset value. And you calculate that net asset value versus the share price per share as well, which you disclose. And that is also very interesting to see in the real estate industry. You see times where real estate trades at a premium to net asset value, and there are also times where, because of cyclicality, they trade at a discount to net asset value. And very much that reflects the future anticipated rent. It also it reflects the risk within the real estate company due to leverage, or too much or too little leverage. I mean, leverage can sometimes expose to risk, as the real estate can be cyclical or is cyclical and can have moves. If you have too much leverage, of course, it makes the equity in your cap stack much more volatile. So NAV is a very important matrix. But the other thing, of course, that often real estate companies are also valued on is the dividend yield, because, of course, and specifically as REITs, as they distribute out majority of their income as a dividend, that is an important base matrix for the investor. And what often investors summarize it to is to have a total return, which is the dividend yield plus the NAV growth of the underlying asset, which gives you then a total return.
Thank you for that. And you've touched a very important topic, which I really wanted to discuss, which is REITs. So, and then in Pakistan, there's only one REIT which is listed. And I think people generally are concerned, or they're not clear whether the capital gain on the underlying property passes through to the investor. So they're not sure whether REIT is the best way of benefiting from the capital upside in a property. Can you explain to us what are REITs and why have they been successful in Europe?
I mean, REITs, very similar to also business trusts that you might be familiar in the context of Singapore listings. REITs have been extremely successful in Europe and in the US. For example, in Germany, REITs were established in the late 2000s, just before the financial crisis. And they give tax benefits so that you don't have to pay tax on the company level, and however have to distribute out a significant portion of your income, of your rental income, or of your net income in this case, because you have to deduct the cost of debt before. But so the idea is very much to create a vehicle or platform that is stock listed and investable for anybody, whether it's institutional investors, whether it's foreign institutional investors, whether it's retail investors, to get access to real estate through a professionally managed platform. and investor base, and however also be tax efficient for those investors and not have too much of a corporate tax on the REIT level. So it's ultimately providing access to the real estate asset class. And why is that so important? And that was the dynamic, and I explain in a minute what we saw in Germany, is so that people could not just have their direct real estate or their own house, which often ties significantly more capital, but also, for example, for providing for their pensions, they can invest a portion of their pension savings into real estate through a professionally managed platform. And that is very efficient, and absolutely they have part of that gain of the value, but on top of that, they also benefit from a relatively strong yield and dividend from that stock. So that is, I think, from a social investment policy is a very efficient and transparent way for all sorts of investors to get access to real estate. In Germany, if you think back, the listed real estate stocks were before 2003-4 below 10 billion of market cap. If you think traditionally, how did Germans invest in real estate? A lot closed-ended and open-ended funds. And so the 10 billion would be versus approximately 200-300 billion of closed and open-ended funds. Just comparing that in not tradable on an exchange products, where investors in the open-ended fund you could redeem, and you could buy on a daily basis, but in the closed-ended fund you are quite locked in for several years before then the return comes back. And with the open-ended funds, for example, it's an issue because if you have illiquid real estate in the fund, however, too many investors at the same time would redeem, you have liquidity constraints. And in some periods you see that, and that's an issue. However, if you have a REIT or a listed real estate, you trade the share. Of course, the price goes up and down, and it depends on what price it clears, but there's no constraint in terms of, no pressure on the underlying portfolio, which is basically the capital is there as evergreen. And so it's traded on whatever the value is to be perceived, or where at what value it clears. So if you think back in those early 2000s when the listed real estate market was relatively small, you saw a wave of privatization of housing stock from the government and from some cooperatives, etc., to private equity managing that stock up and then IPOing it. And so now I don't have a very fresh number, but I would see that it possibly, in terms of overall size, gone up to 50-60 billion from 10, like possibly even higher. I haven't really accumulated last, but you have certain individual companies that have over 15 billion of market cap. So significant for the overall investable share classes, and as meaning through the exchange, but also significant for the real estate market. And it just allowed new type of investors to access the underlying real estate in a very transparent, efficient and way to benefit over the long run in that growth.
Thank you, Georg. That's very interesting. As you described, that a listed structure actually brings liquidity to an otherwise illiquid asset class, and that liquidity is very important. And I think the second example which you gave of Germany is very pertinent and very important for Pakistan. And I'll just elaborate on what you just said, that Germany had the stock of real estate, these apartments and housing, which was state-owned in the past, and then they've, over the last 15 years, as you mentioned, that since mid-2000s, they have been privatizing this real estate and giving it over to private equity, and then a lot of that real estate has come into the market. And as you described, that the size of the market has increased from 10 billion to 50 billion because of this increase of supply. And before the call, Georg, we were discussing that you were saying that this is a very attractive asset class for investors to own because it's a steady, guaranteed, stable rental yield which comes from these assets. So which is very similar to in Pakistan as well, that when people invest in real estate, they often look at the rental yields. Our rental yields are lower, but at least that's a factor.
Quickly, one thing to add, if you think on the other side, you had entrepreneurs who now through the listing of companies also got access to capital to could expand their business and create new projects that of course then create also more habitable space or new offices, and really it's an investment into infrastructure as such, and that becomes then quite a circular in a way. It grows as such because you have better product, you have dynamic, people make money on it, you create an industry around it as well, you have real estate brokers, you have construction companies that can build more. I mean, the whole thing starts to become very, very healthy for an economy, while you create more space, while you improve the underlying, and you just allowing to have alternative sources of capital flowing into that industry. And I think that is very, very important because it goes together.
Absolutely. And on that question, Georg, in Pakistan, the government wants to develop affordable housing. And there have been various targets. We have heard about 5 million homes which they want to build. The essential point is that we have a growing middle class and a young population, so there will always be need for affordable housing. Can you give us example of Germany, that how did Germany tackle this issue, and how did they develop and grow this asset class of affordable housing?
I mean, it's still also a challenge in Germany, and there is an undersupply currently of around 1 million homes. That is the estimate which you find in the press. So, however, there are various ways you can think about it, and this is quite a dynamic process that is ongoing in Germany. But you find discussions now where, for example, municipalities would provide land, people develop then the housing stock, and then you could even think of letting it back to the municipality at a defined rent. What you create through that is ultimately a stable municipality or government-backed cash flow that an investor can then very much have certainty over, let's say, 30 years that the cash flow is coming, and it very much becomes like a long tenor bond, and therefore the pricing of it is significantly more attractive than if you would have a property where it's uncertain whether the cash flow comes or not. And so you can really, with engineering those or bringing those different interests together, you can create something that allows investors, whether it's domestic or foreign, whether it's individuals that are saving for their pensions, or whether it is entrepreneurs that benefit from that capital. You bring the different things together, and you can create something that really allows you to grow housing stock, and you can basically deliver something to the overall that is very meaningful.
Absolutely, that's very interesting. That you are suggesting that essentially you can convert these real estate projects into infrastructure projects which have a structure where there's a guaranteed rental income, and once you do that, then raising financing for it becomes much more easier. And that's a very good point, because in the case of Pakistan, we do have experience of infrastructure bonds, because our motorway and some other infrastructure projects have been structured like that in Islamic sukuks. So perhaps that could be a way of financing housing projects as well. And you described that that's how Germany did it. Georg, moving ahead, you mentioned co-working space, and at Camden you developed one of the largest and best co-working spaces in the UK. But since WeWork's fall from grace, there has been a lot of question marks about co-working in terms of the business model, whether the business model works or not. And in Pakistan also, there are a few co-working spaces which have come up. What's your opinion on co-working as an asset class? Do you think that the business case works? So was it a WeWork specific issue, or do you think there's an asset class issue?
No, I think co-working as such is absolutely working and will have significant future growth. I mean, co-working compared to the overall office market, one should not forget, is still very insignificant. It's still very small. But if you think that flexibility, and even now through Corona or COVID, there's the demand for more flexibility and altering the office model, I think co-working as such is something that absolutely will have a very strong future and is required. The question then is, what is co-working? And there are various ways. It's a little bit like if you say the hotel industry. There are all sorts and forms and shapes of co-working. However, flexible office and higher utilization of space, because I think that is something that is very interesting. If you think of real estate as being a space that can be utilized in a certain way, and if you think that how many offices at how many times of the day are empty, and if you increase the utilization through sharing certain, to maybe double using certain spaces, you can really increase the overall return on something. And I think that is a dynamic that is not stoppable, irrespective of what happened with WeWork and what happens to others. I think WeWork, even there on the co-working, has been very successful. If you see how rapidly they expanded, for example, in London with their spaces and how occupied they were, I think that's a huge success story. It's all then, of course, a question at what is the value of certain things. And if you look at the Regis, which is a traditional player on serviced offices, they haven't been as hyped, but they've been very sustainable. One thing, of course, you need to understand is the dynamic in certain cycles of the economy, because you have short-term user contracts with underlying often long-term rental contracts of the space if you don't own the space. So if you have that maturity mismatch, so there are certain risks that can come up. Let's say there's a bigger wave of Corona, co-working space would not be able to open. You then have short-term contracts where people then resign, and you suddenly, as the operator, would have a long-term contract underneath where you have to pay your landlord. So those risks need to be assessed and need to be seen, and one needs to be realistic. And as more in the real estate, if you go into operational involvement, of course, also certain risks will increase. For example, the hotel industry, very similar. And so I think those things need to be being assessed and being seen. However, the underlying flexible office space, I think has a bright future, and there will be new forms and ways that people will involve. And also, if you think about traditional serviced office, how that looked, and now quite a modern co-working facilities, how they look and how they enhance in terms of style. Very much a bit like hotel industry in the 70s, when you had a few bigger chains coming up, this much here and there. And I think there will be an evolution over the next 10, 20 years in that industry. The same applies then for co-living, which is more infant than the co-working. But ultimately, the theme very much is around utilizing the existing spaces on a higher frequency and allow people to have convenience, flexibility, being mobile globally, whether they work at home or then have different offices and so on and so forth, because I think that's the overall trend we see across different industries.
Thank you for that, Georg. That was very insightful. And as you said, that co-working you think is here to stay, because that's the innovation on the business model to optimize the real estate which already exists. And the examples you gave of the hotel industry is very apt. So thank you for that. There's another real estate type which you mentioned while you were talking earlier, which was the use case in logistics. Now, this is a new area, but we keep on reading about Amazon's investments, and especially across Europe. Can you tell us, for the audience in Pakistan, what is this asset class in terms of the use of real estate for logistics? And
yeah, light industrial logistics is possibly now with Corona. I mean, even before they were one of the winners, but they're even more seen as a winner. And
sorry to interrupt. Just technically, can you just move back a bit?
Yeah.
Yes, that's much better. Thank you.
Light industrial and logistics been like a very big success story. Of course, what drives this global trade, it's e-commerce, and it's a change also around retail going into online. So there's been significant demand, and you see international investors that invest globally because things have to be delivered globally, and you see also there's under supply. There's still in Europe, if you think there's not enough logistics and light industrial spaces, and the yields they used to trade at, I would say, around 10%, 8%. They've been a higher yield required in the talking 10, 15 years ago compared to offices. It hasn't been perceived as attractive, but now yields came significantly down and possibly halved, because there's so much demand. There's also the evolution, of course, of more sophisticated, highly technology-driven logistics spaces. If you see that you have the same-day delivery, like in London or even across the UK, and very fast delivery times across Europe, or even into the US, you need those spaces, and that has been an asset class that has been very, very looked after, and a lot of investors want to expand there even further.
Thank you for that. So you're saying it's a structural growth area because of the shift towards digital. People are converting their real estate into warehousing. And your point, I think that was very interesting, that because this is a global, e-commerce is a global industry where there's trade between various companies, there is a bigger investor pool who is interested in this asset class because it's actually linked with their operating business. And perhaps, that's why we have seen in the case of Pakistan, Daraz, which is owned by Alibaba, has also now set up their own warehousing. So perhaps there could be capital influx into this.
Georg, and you see there also, one thing to add, you see there also all sorts of investors. I mean, private equity was always very interested in it, and they've done a lot of the foot legging to build that out. But you then also have significant now listed companies, like for example, Exigro in the UK. You see family businesses building up in certain regions, certain infrastructures that they then either IPO or sell to any of the largest. So you see consolidation. You see significant fragmentation still in the, call it, less technologized warehouses. You have then the very large warehouses which have computerized logistics systems and so on and so forth. So it's really as such a part for real estate that has grown tremendously on all different levels, and for more conservative, whether it's the pension funds or insurances, it become one of those asset classes where they really like to invest into at significantly reduced yields. They're willing to pay higher prices because they just see that structurally and in the coming years, in the future, there is demand for it, and they are very basically certain that the cash flows will be very attractive.
Thank you. That's very, very interesting and important point. As you said, that that the industry is fragmented and there's a consolidation play. And as you rightly pointed out, there are warehouses now of various forms, shapes, and sizes. And because this is something structural, it has happened in other markets, i.e. the shift to digital. There is bound to be growth in that asset class in Pakistan as well. And perhaps that could be opportunity for some of the investors who are listening to you right now. Georg, German real estate has been a really good asset class, and the prices have gone up. A, what has Germany done right? B, in the case of Pakistan, we have not seen a lot of capital coming in the formal market. So if somebody has a project in Pakistan and they want to, let's say, set up a residential project, what's the best way they can structure their project in order to raise capital? Based on your experience of Europe. So I'm conscious that you don't know Pakistan, but you can just phrase it from a European perspective.
Let's think what drove the real estate market in Germany. There are different dynamics, but the biggest impact in terms of growth, like if you think about the yield compression or the multiplier expansion that you've seen, that correlates significantly with the interest rate environment. That's possibly the biggest driver. So if you have low interest rate environment, you also have then, of course, a compression in the yield that you would require on a long-term cash flow out of a real estate, because people can't get those returns in bonds or in the fixed income market. Therefore, they would substitute that, for example, through real estate. That is one thing. The other thing is the fundamental rental development in a country and what drives that. And that is something where, irrespective of the interest rate environment, you can basically generate a lot of value and can make things very attractive also for investors. If you think of the German residential market, that has seen significant rental growth, and that was because you had a more liberalized market and less restricted. You had more investors coming into the market and driving also the professional management of the asset class. In the past, that has been very much neglected, and as that dynamic and professionalism occurred, therefore also rents could be managed up in a similar way. Comparing it when we discussed around Camden markets and the estate there, things influence each other, and therefore people are willing to spend more for rent, or they take maybe less space, but therefore they pay less, but they have more convenience associated to it. So if you have the rental growth, that is a dynamic that we've seen in Germany also, as well on the residential as on the commercial side. If you think now, the second part of your question, the second question is what if you would develop? I mean, you need to think always from very much the project and what is the value creation one can generate out, or what is the aim you can generate with that project. So the cost is always a good starting point to see how can you reduce costs to create the value. And the value is then driven from that future cash flow and other influences which you have under control as being a developer, and therefore, and also what you want to achieve. It could be affordable housing. That is the value you create. It's not about expensive, it's about making it right and to have sustainable cash flows ultimately and growth within, and therefore create that project. If you then have a project that has significant upside or a margin that allows you then to source the right capital, you always have to try to get the cheapest capital in that you can have access to, and of course that is normally debt. In the German context, that would be loans from banks, could be from Landesbanks, from state banks, could be from commercial banks. That is generally tends to be the cheapest capital. And you would see on projects loan to costs, like often they differentiate between loan to value. That's the future, what you create as a value of that could be also seen as a sales price of it, or loan to cost. In this case, the cost for the project, you see levels there of about 60% of loan to cost that senior banks would give you. And then the question is, how much do you want to invest from your own equity to fill that gap, or whether you would take alternative financing pools from, could be private equity, could be mezzanine providers, which are people that specialize in exactly capital types between debt and equity, meaning there's a fixed interest, but there's also some upside share. So it's a hybrid type of capital. So you need to see whether you have access to any of that to make your capital structure more efficient, i.e. you use yet less equity and therefore increase your IRR on your equity on the project. However, always keep the risks in mind. In development, in real estate, things often take longer than anticipated, and don't just believe in the underlying business plan, because you always have to be very cautious and realistic. You need to go through planning, you need to do this and that, and so on and so forth. Construction often takes longer than anticipated. So in a simplified way, take debt and use your equity and then develop such a project in an efficient way. Of course, one can then think whether that can be listed on the stock exchange. One can think of whether you do in Germany, for example, if people develop residential, they sell the units, and at the point they sell it, even before they complete it, the person who buys it has to make a down payment. So that down payment can be recycled into the construction. So all those different things you have to, of course, understand your regional requirements or your country-wise requirements. But I mean, those are all thoughts one can accumulate, and I would think if you have an underlying healthy project with a significant margin, meaning you have the costs under control and possibly you acquire the land at a good price, then it shouldn't be difficult, in my view, to find the right partners, because everybody likes to make money, and a lot of people like real estate.
Absolutely, people love real estate, but you're spot on that essentially managing the costs is the important part, because as you said, that often costs are higher than what you anticipate, and the projects often get delayed. So managing that risk is really important. Georg, before we open up for question and answers from the audience, there's one question, my final question from my side, is that a lot of students are watching the video, and it's also going to be on our online MOOC, which is KASB Certificate in Investments, which is on kasb.teachable.com. What will be your advice for students who want to enter into a career in real estate banking as well as real estate investments? You have been on all three sides. You have been an operator, a financier, and an investor. How can they develop themselves right now? And when you're interviewing people in your roles, what do you look in a graduate when you interview him?
Look, I think real estate, it can be a very, very interesting asset class to make a career. And it's been very established. It's vast. It's in many ways still also a bit underdeveloped compared to other industries. For example, if you compare the automotive industry in Germany with real estate and also the finance, like the banking industry, those things are far more developed than real estate traditionally is and was, which in its own right gives a significant opportunity. I think real estate also is a relatively simple asset class because you have very clear drivers of the value. And when people apply to us and interview, I often ask them very simple questions. I mean, tell me, how much is this building worth? And how would you assess the value of a building? If you have those kind of few dimensions in your head and understand what rents mean, what yields are, what the multiplier, what debt is, what equity is, what value is, and how that's driven, and how you can create more, you are then, I think, in a very good understanding. And then you have to think about what you want to do and what would be that drives you. Are you more like a financial engineering guy, or would you want to advise as a banker on financings? That could be one thing. You're quite detached from the real product as such, or the real building. Or do you love to develop, which is a very exciting thing you learn, but you would enter into different avenues there. And if you want to go into development, I think it's always to try to learn from other people that have that experience and learn there from the best. And that could be regional people, it could be families or entrepreneurs that really done it for 10, 20 years and really know their tools. Could be also international big firms that done very well, and you learn there. If you go into the financial side, of course, you could start your career as an investor. You could start your career with brokers to become more like a salesman for real estate. There are often big broking shops have their investment arms. You could start within banks that have asset managers or investment banks where you advise. That's a bit what your character is and what you want to be after. But I think you should always think of real estate in a very simple way, and see also what would you want to be. Are you more entrepreneurial driven? Are you more somebody who likes to be in an employment role? And there you can navigate across the industry. You have all those different opportunities. It also allows you, the real estate industry, that you later on change in between, because ultimately it is a simple asset class, and it's a global asset class. And so I think it's sometimes overlooked a little bit by highly talented people. I think it's very thankful. It's very rewarding also in terms of pay and that. But and it also has a significant social impact or into the society and impact. So I think it is a very interesting thing. But yeah.
Thank you. Thank you. That's very, very interesting. And thank you for highlighting that, as you made it clear that it's a simple asset class, it's a global asset class. So the skills which people learn in Pakistan, they can also take it globally. And the other, I thought, interesting thing which was important for people in Pakistan is that you highlighted that there are various roles. It's not just, if you want to specialize in a career in real estate, you're not just limited to being a developer, but there are various roles, whether it's, from a broker of a property to an investor, so in an asset management company, to a financier, i.e. in a bank, or in the financial engineering in terms of structuring the best product for raising capital for real estate, or a developer. So it's a big
maybe
career.
One thing to add is, Ali, I mean, I started my career not in real estate. I started on investment banking side at the time with UBS, and I decided at one point, which was 5 years into the career as being a generalist on M&A and equity capital markets, to specialize on the real estate sector, where you then specialize into one industry, and I choose real estate. And that I think was a very good decision at the time, because it was a very dynamic area also, with Germany, with REITs being introduced, with having new ways of capital and introduced into the real estate industry. And then from being a banker, then changing into become an executive on a listed real estate company here in London was very exciting, because you see then how you drive the underlying asset value and how you create value. You as a team, and that was very exciting. And now my current role is being an entrepreneur, where we have a relatively efficient and small team, where we give financing to German institutions or German developers and drive their value, to be there far more flexible and in a smaller setup, but again very sophisticated in terms of how we engineer our investments, and it just shows there's a lot of flexibility in it, and yeah, it's a very, very big asset class.
Absolutely. And Georg, there are regulators from Pakistan who are listening to this webinar, and I think your talk makes it very clear that how big the opportunity is, and what are the various facets of this opportunity. That not only can unlock a lot of value for private investors, but also for the state, in terms of helping the state finance projects for affordable living for people, create jobs, create housing, and for people, it can also create jobs in the financial sector by opening up this asset class. And I thought that what was very inspiring from your talk is the example you gave of Germany, that how quickly it can develop once these enabling factors are there. Now, moving to the first question, we are open for Q&A. If you have questions, please write it down on chat and I'll just read it to Georg. We have a question that, in the case of Pakistan, we have seen the price of the REIT, which is traded, has not increased in line with the price of the underlying value of the property. Is this common in Europe as well, that do REITs trade at a substantial discount to their NAVs?
That depends. And as I said before, you see REITs or listed real estate trading at premiums to NAV and discounts. And if you think, for example, the London market, we had premiums to NAV in the 2012, 2014s. I mean, Marketech at the time was IPO'd at 100% NAV premium, because of the anticipation of the future growth in the market, in that portfolio. Now at the moment, you see a lot of the London listed companies trading at significant, and some of them up to 60% discounts to NAV. For example, if you look at the retail, listed retail companies, why is that? Because shopping centers retail is very much under scrutiny, and whether the rents are sustainable or whether they go down. Some of those companies also have significant leverage, meaning if you have more leverage, your equity portion is smaller. So if the value starts to decrease, the impact on the portion of equity is much higher. So all those things matter. What the discount to NAV or premium to NAV is in an efficient market, it would be the anticipation of the future outlook of that NAV, because the valuers will do their appraisal every half year, every year, but they may not anticipate the same what the capital market anticipates, meaning what the value could be. The other thing that you see sometimes in stocks is also illiquidity or liquidity constraints in the underlying share trading. If you have smaller companies that have not so much liquidity, there might be quite a huge volatility in the share price, meaning they go up or down because of NAV, and often they tend to trade at discounts to NAV because the liquidity is just not there, and therefore for investors to go in always requires them patience when they want to divest, and so those different impacts can cause that. Why a share price has not gone up and NAV versus has gone up, I mean, NAV is based on a third-party appraisal, and that also is then linking in the expected rental value, the multipliers and impacts that might have changed since that appraisal and might be perceived by the capital market in a different way.
Thank you. Thank you for explaining it, and that was very insightful. That, as you said, that right now some UK companies are trading at a 60% discount to NAV. So it means that it's not uncommon for this to happen. Georg, on that point, like 60% is a massive discount.
I would say to be there fair, I mean, I would say the corridor of +15, -15 is like more what you would see on in a normalized base. But now with being UK in Brexit mood, with having Corona, and I'm talking about retail, for example, at the same time, logistics are trading possibly at or slightly above NAV. So you need to very specifically look which in their sub-asset classes, what are the drivers. To have a 50-60% NAV discount is extreme.
Totally. And it's a related question. What's your view on real estate in UK and Germany right now?
Very different UK and Germany. I mean, and why is that? Because you have a different interest rate environment. Of course, both have low interests, but you have with EZB now pushing a lot of capital into the market generally, and I think nobody can foresee any rates to grow. I think I'm very optimistic for the German, generally for the German real estate environment. Again, you have then to differentiate between the different asset classes. The biggest winner possibly is logistics and light industrial, as we discussed, and then residential. On the commercial side, office is a bit the question of how will the new work environment with Corona and post-Corona look? Will people change their habits with going to the office and not? And however, fundamentally pre-Corona, there was still in the metropolitan areas an undersupply, so prices grow and now stabilized and possibly may decline a little bit. Then if you think hotels, of course, there was now with Corona a significant impact on that asset class. And then if you go into data centers or self-storage, they've done extremely well. Because of course data centers is in high demand, and self-storage is also again coming to the point of utilizing space more, that you don't need to as big an apartment, you can put stuff in a self-storage, or you don't need to have a big company, whatever workplace, because you can store your things. Let's say you are an agent for pharmaceutical products, you can store in a self-storage and you don't have to have a big office. So those asset classes have gained. In the UK, it's a bit of a different dynamic. UK, of course, had a massive long rally in real estate. If you think that how house prices developed over the last 20, 30 years, again, one of those points, if you have the right dynamic in a market, it creates wealth across the population. It creates also safety and security for their pensions, because people buy a house, let's say for 100, and then after 20, 30 years, if that's worth 800 or 700, that's significant value creation. While they lived in the house, and also it protects them when they're older. And if they would sell it on, they could downsize or what. So I mean, that's a trend you saw in the UK, but of course that has slowed down. Brexit gives a lot of uncertainty economically. You have a country very different from Germany that is heavily indebted. Germany is not very heavily indebted as a country, which makes it different. Therefore, the stimulus now for Corona can't be as significant, or is not as significant as you see, for example, in Germany. On the commercial real estate side, again, logistics is doing very well. Office, it's a bit of a question mark at the moment with, and again, here you differentiate between London and non-London. I think London is holding up relatively well. And then on the retail has been in a difficult spot in the UK and globally since quite I would say about 2-3 years, whereas Germany has been a little bit protected from that, because also possibly they haven't expanded with shopping centers as much as, for example, UK or the US or Australia, but retail is a little bit in and hasn't had that significant rental growth in the last few years or the last 10 years that you saw in the UK. Retail has done very well in the last 10 years and had seen on the high street significant growth, but also shopping centers. If you think like places like Westfield have established in London, but that is all under like in a difficult spot. So I think the sentiment in the UK is not as positive as you see in Germany. Also, still we are here in a quasi lockdown. Shops have just opened on Monday, whereas in Germany they opened, I would assume, about 4 weeks ago. Things like that is different dynamic.
Well, thank you for that, again, very comprehensive answer and a lot of insights into that. What I thought was important is that, how it showed that real estate leads to this virtual cycle that, once you get it right, it actually self-fulfilling. And you gave the example of UK, how for almost, multiple decades, it created a lot of wealth, not just for people, but for the whole value chain who was involved in it. So I think that's really important. Quickly, we, and
one thing to also, Ali, one thing to add to that is also inflation. And if we see in the Western world how much money is being put into the system, we don't see inflation, I think, yet. But I think real estate stays real estate, and prices will change, but it stays as something tangible.
And linked with that, there's a question from Junaid Imran. I'm just reading it. I'm not technically competent to understand the full question, but his question is, what parity is there between interbank interest rates and cap rate used to determine real estate valuation? What parity is between interbank interest rate and the cap rate, which is used to determine our real estate.
But the cap rate is more the price for the square meter. So you have the interest, you have the yield, the yield that or the reverse is the multiplier, which is if you have, let's say, 10 is your rent and you have a multiplier of 10, then the value is 100, or it trades at a 10% yield, meaning 10 is the cash flow you have for the value 100. So that is and if you compare the yield of real estate, which is, of course, as I said before, often cyclical, because that yield compresses or expands, and that is correlated significantly to the interest rate or the interbank rate or the generally underlying interest rates however, the spread between the interbank rate and the average, let's say, office yield is not staying constant. I mean, you see, for example, that, let's say, office yields have come down from 6% to 4% in Germany. However, the interest rates have come down from let's say 3% to 1%. So the spread has increased actually. And so you see their dynamics, which is not something that is always the same, but I think the correlation overall, of course, is very logic, because often real estate is financed through debt, and that is, of course, then linked to also the financing costs. So let's say you have your 5% yield on something, you can finance it with 2% debt, let's say half of the real estate. Therefore, with that leverage, you can enhance your return on your equity significantly through that, and therefore interest rate drive significantly the value, and the meaning the value, but the underlying yield that drives that value.
Thank you. So interest rate is the main drive, is the key driver of real estate values. The final question.
The rental growth, as I said before,
and the
it's
growth,
not just external. It also, if you can increase the rents, you have a nicer building, you have more demand, you create opposite a school, and therefore the housing is more attractive, and so on and so forth. All those things impact, and that drives you the rent.
Got it. Georg, the final question. I'm conscious that we are over the time now. And it's a question from Zen. I'm rephrasing it in a different way. That, if I know you invest in Germany in developing projects, and you don't invest in, emerging markets. But let's say if you were an investor and somebody were to come to you from Pakistan and, say that I have a project, would you finance it? How would you evaluate it? What are the kind of returns you would expect from a market like Pakistan? What are the qualities or conditions you would demand in the partner? Is there some minimum threshold which would make sense to an investor such as you, a minimum ticket size? Would love to know, how would you think when you're evaluating a project from Pakistan?
I mean, first of all, you would start with the currency, which is a very important point, because currency fluctuation, that's also one point that, of course, in the UK at the moment, some investors have been quite hit by the devaluation of the pound over the last few years since Brexit. So I think currency is something that needs to be very clearly played, because real estate projects often are several years, and you don't want to have a nice underlying project, but if you think in a different currency, or if you are a different currency investor, if your margin or your return diminishes due to currency fluctuations, that is something one needs to be very, very clear at. The other thing then is, coming back to my point before, is what is the project, where's the value creation, and what is the edge that developer has. I think if the developer can demonstrate where the future demand comes from, whether it's rental or whether it's somebody buying it, and how to create that value, and being a reliable partner in terms of being able to manage all those different phases of a development project, and also with the municipalities around planning and so forth, to get their certainty. Then, of course, it's something that often the international investor can bring, is the financial structuring and all that. I think that is something we when we do projects with partners, we often bring that to the table. I want somebody that finds a very good, attractive land, has a very clear plan how to execute from that land into the building, has no risks. That I need to be able to manage my risks. And one risk could also be in real estate planning. If I'm dependent on municipalities, and a project could drag from being a 2-year project to a 5-year project, that's significant risk, and I don't normally expose myself to any of those risks. However, if it's clear, if there's a confirmation from the government or whatever that the planning is granted or to be granted, and I know it's solely about getting the construction going, and I would have there also alternatives in case something goes wrong, that I can close that gap, then I'm comfortable. And so I think you need to assess where the risks are, need to demonstrate that you can mitigate those risks, and not just believe you can. You need to demonstrate that, and then have the conversation with the investor. And I think I find it often very complementary to have financial investors and local developers that really understand the local to-dos, and that can be highly accretive.
Great, thank you so much. You're spot on that. FX is a big issue, and perhaps the most important thing with which an overseas investor would look at in emerging markets, and that has been a concern for Pakistan, given the volatility, or especially recent volatility in exchange rate. Thank you so much, Georg, for your time. This was extremely insightful. I learned a lot, and it was enjoyable talking to you as always. The recording of this video will be on KASB's website, and people can download K-Trade app, ktrade.pk, and invest in companies which are listed on Pakistan Stock Exchange, and also follow our research. Thank you, Georg. Have a wonderful day.
Thank you very much. Thank you, Ali.
Thank you. Bye-bye.
Bye.